What's going on, you guys? My name is Zach Hartley, and in this video I want to explain to you why the stock market tends to perform poorly when Federal Reserve interest rates are expected to increase. I'm going to explain to you that relationship, how it works, and how you might be able to make some money when the interest rates are going up. Here is everything you need to know. Let's go. Okay, so first of all, let's just talk about who sets the interest rate, because this is really important. And basically, the government sets an interest rate for lending money to banks, and then companies and consumers borrow money from the banks. Banks make money by borrowing that money at one interest rate and lending it out at a higher interest rate, and that is their profit margin. That is how they make their money. Now, the government agencies that lend the money to the banks in Canada is referred to as the Bank of Canada, and the USA it's referred to as the Federal Reserve. And the interest rate that they lend that money to the banks at is sometimes referred to as the federal rate. Now, how does all of this impact us? Well, to put it very simply, if interest rates increase, then we have to pay more to borrow money. Now, this can affect both consumers and businesses, so let's start with consumers first. As a consumer, if you have a variable rate mortgage, which is what most people have, that means that your mortgage is basically going to be a prime plus X rate, prime plus 1, prime plus 2, and as the prime rate or the Federal Reserve rate increases, that means that you're going to have to pay more in interest on that exact same mortgage. That means that you might have less money left over at the end of the month to spend on goods or services or other products. If you have a student loan, it also means that your interest payments are going to increase relative to your principal amount or to your outstanding balance. Also, if you have a line of credit or a personal loan that is on a variable rate plan, it will increase the interest rate associated with that plan, basically meaning that you're going to pay more to borrow that money. And unfortunately, it means that a large amount of consumers at the end of the month will have less disposable income. That means that they're going to be buying less iPhones, less headphones, less new cars. People will have less money to spend, and that means that these companies might not be able to sell as many products. It means that we might see a small slowdown in the economy and how much money people are bringing in and spending. So that's how it affects consumers. Now here's how it affects business. So the main thing here is that it will cost more to borrow money, and because it costs more, that is an expense that the company has to pay, and that means that there's less profit left over for shareholders. If your company generates less profit, that means that they're going to grow at a slower rate, and that means that they're probably going to get lower valuations. Or if Apple's currently selling at $200 and all of a sudden it's forecasted that they're going to make less profit, that means that their stock price is probably going to come down and adjust to the new forecasted income projections. And so that means that basically everything is going to sell off because almost all companies are borrowing money. Now, also on top of this, it means that companies with a lot of debt, so if you have a lot of outstanding bank loans or debt loans that are variable, or if you have very little profit to cover those expenses, these are the companies that will usually be hit the hardest. And we are seeing that right now in the market. I'm making this video on January 24th, 2022, and a lot of the high-tech growth stocks that are growing very, very quickly but don't have much profit right now, those are the stocks that are selling off the most right now, and the stocks that are generating consistent earnings and are already profitable, those are the companies that are weathering the storm the best right now. And so all of them are down. However, there is different degrees to how much they are down, and it is caused by a forecast for increasing interest rates. Now, how does this affect the stock market in general, and what is the end result? Well, stock prices fall because consumers have less money to spend and companies make less profit. It's kind of like a double whammy that happens when increasing interest rates are expected. It's like companies are going to have to pay more to borrow that money and consumers are going to have less money to spend. So it does make a very large impact on the economy. Now, there are some sectors that are going to win when interest rates increase. Traditionally, one of the best sectors for an increase in interest rates is the banks, because think about it this way. Banks borrow money from the government and they loan it to companies. And so if they can loan it and let's say they want to make a 50% margin, right? They want to make 50% when they borrow it from the government and they lend it out to people. That 50%, obviously that's not the real number, but that money there is called the net interest margin. Now, let's say that the Federal Reserve rate was 0.25%. That means that they're going to loan it out at 0.5 and they still make 50%. But let's say that that interest rate was 3% and they still want to make 50%, that means that they would then loan that money out at 6% and they would make an entire 3% of profit on that money. And so as interest rates increase, banks tend to make more money, which is what we have seen in the market right now. A lot of Canadian banks especially have seen a dramatic run up as the expectation of higher interest rates has settled into the market. And so banks tend to be one of the large winners when interest rates increase. Now, the other winners, and there's a couple, but one of the ones that I'm going to point out are bondholders. Bondholders usually tend to increase because that steady and consistent bond yield becomes very, very attractive when stocks are selling off. A bond is really, really nice because you give in $100, you're going to get that $100 back at the end of the bond, and you get to collect interest in between. So you know that you're going to make money. There's almost absolutely no risk of losing money, and it's really, really nice. Your only risk here is inflation, and bonds tend to go up because the higher interest rates usually drive down inflation. And so bonds become very, very valuable, or any companies that own a lot of bonds. For instance, a lot of insurance companies have to be very, very safe with their money. Therefore, they invest their extra income into bonds, and when those bonds go up, the insurance companies also tend to do well. So that is another sector that you could look at if you're looking for inspiration when this industry and when these rates go up. Now, what should you do? I'm not a financial advisor. This is not a sponsored video. This is not financial advice. Here is what I am doing. That's what this title should probably say, is here's what I am doing. So here's what I am doing. I am checking all of my balance sheet. So if I own a stock right now, I'm going through the balance sheet and I'm checking to see how much debt they have, how much cash they have on hand, and what the current financial situation of the company looks like, and whether or not they're profitable. If they have a good balance sheet, they're already profitable, I'm probably going to hold on to that stock. We'll see how things go. Now, the second thing you need to do is you need to sell the losers. If you have a stock that isn't performing well, that isn't doing good for you, and that's down right now and doesn't show many signs of coming back, you need to cut that loss. You need to fall out of love with the company, and you need to get it off your portfolio. Stop looking at it every day because it's dragging you down, and you need to start looking for new opportunities. Keep it on a watch list, check it once a day or once a week, but you don't need to hold it if you can find better opportunities out there. And number 3 is you need to build a list of companies that you want to add to or buy into and wait for an opportunity. So for instance, me personally, I have a whiteboard right here, and there's almost always a list of 10 to 15 stocks on that board where I'm like, I really like this company. I've already done the due diligence. I've done my research. I don't own it yet, but I want to when the opportunity presents itself. And then I wait for a technical trading opportunity. I wait for all the buy signals to line up. I know that I've already done my financial and my basically fundamental research. Now I wait for a technical opportunity. When the stars align, I take that position and I get into the stock. And that's what I do to kind of build out my swing trading in my long-term portfolio. I think that's the best way to do it, and this is my strategy here. Now, if you want to learn more about it, and you want to check out what I do on a regular basis or learn more about how I trade, then you need to check out my Stock Market Fundamentals course. It is hosted on Skillshare, and it is completely free when you sign up with the link in the description down below. You get either 2 or 4 weeks depending on where you live, and it's really, really nice because it's like the Netflix of courses. So you can sign up for my course or you can sign up for any other course. It's the exact same price. You get full access to everything, but you can do my 10-hour course that will walk you through step by step everything you need to know to get started in the market. There's over 10,000 students that have already gone through the course. There's over 380 reviews and 1.6 million minutes of watch time. I promise you it'll be well worth your time. You will learn a whole lot of new things, and it's completely free. It won't cost you a single penny. Use the link down below to create an account. Cancel it when you're done with the course. You'll get the entire thing for free. All the links are in the description down below, and if you get any value out of this video, please remember to click that like and subscribe button. I sincerely appreciate it, and we'll talk to you soon.